What is the big mistake that traders are making? Now, I've certainly fallen into this trap myself, so I'd like to talk about it. The mistake is that you treat all market conditions the same. They're not the same. Every single day is different. In fact, the market goes through these seasonal fluctuations where we know that trading volumes fall off. We also know from the price action that the market has a tendency to keep doing what it has been doing. So we're going to take a look at how that context dictates how we should be trading. There are going to be times when we really step up to the plate and we trade large size, and there are going to be times when we have to lay low. That's where we're currently at right now. August is typically a horrible month. The only exception to that was when the Fed was raising rates. This is 3 years ago, and the Jackson Hole meeting, Powell came out and said higher for longer. The market wasn't expecting that, and we had a lot of market volatility in August. But typically, this is a time when people are going back to work. They are taking their last vacation days while the kids are going back to school. Politicians are in recess. The Fed's in recess. This is a really dull trading period. So first of all, this is when you should schedule time off. I always schedule time off in early August. That removes the temptation to make any foolish mistakes, and you're giving yourself a break. We're traders. We work hard. We need to take a break as well. And so why not do it when market conditions are less than ideal? So first of all, that's something that you should consider doing. Schedule time off in August. Take a week off, take 2 weeks off. And this is very typical. It's the summer doldrums. There's not a lot of news coming out to drive the market. The other thing that we can take a look at is, what is the market currently doing? Well, you can look at it from a swing standpoint and say, hey, this market's in a great rally. Look at this. It just keeps climbing. And it certainly feels that way. But upon closer inspection, you can see that we have tiny little bodied candles and this gradual float higher. This is a very difficult environment for day traders to make money in. So what is the market likely to do? It's likely to continue to float higher, but when it gets overextended, we have these tiny little corrections that last maybe a day, maybe 2 days, and then the market rebounds. Well, those little dips in here are your opportunities. This is when you can get a little bit more aggressive. And so you get this dip, you get this rebound. This is where you can be a little bit more aggressive. Now the price action starts to flatten out and you get this compression. Again, nothing much going on. Get a little bit of a poke higher. You have to wait for this dip. And as soon as you get it, this is where you can get a little bit more aggressive. This is where you can get a little bit more aggressive. The market is currently making marginal new highs. What does that mean? Well, it means that when we come out of these dips and we make a new high, it's just a marginal new high. It's not substantial. What we'd like to see is more along this lines, where you get a dip and then you get an explosion through that new high with great follow through, some nice stacked long green candles. And when you don't get that, so we've got a marginal new high here and then a dip. We have a marginal new high here and then a dip. Now we're trying to get through that all-time high, and we're starting to see some resistance. We can see that in the intraday price action. So that tells us that sellers are not far away. They are keeping a lid on the market. So yes, the market's floating higher, but in a very, very stubborn fashion. So as we get into September, we've got the jobs report coming up next week. That's going to be big economic news. We have ISM manufacturing, ISM services coming up. So these are going to be market drivers or potential market drivers. The jobs report probably going to come in pretty decent. We've had 229,000 initial jobless claims last week. That was a little bit lower than the week before. So that's not a bad number. I don't think that a bad jobs report, let's say it comes in at 50K, I don't think that that's going to make the market roll over, because the Fed is already signaling a willingness to cut rates in September, and that's all the market is focused on. So let's go back to the mistakes and how traders are trying to force trades right now when conditions are less than ideal. We're going to go into a 30-minute chart, and we're going to see if we can find any patterns that we might be able to lean in to when we are day trading. And so what we can see is that you get these dips, these market dips. When they find support, we get a nice day or two of follow through. And then now, all of a sudden, the upside starts to see some profit taking. You start to see resistance building. This is when you have to be a lot more passive. You can't come into these situations and expect that you're going to get sustained intraday movement higher, because profit taking is starting to settle in. The other thing that you need to realize is that when trading volumes drop off, the average daily volume, 60% of that activity is program generated, program dominated. Well, when you have long-term asset managers coming to market and allocating funds, then the percentage of daily programs that account for the volume is less. So when you get lots of long-term money coming in, maybe it's not 60%, maybe it's 50%, maybe it's 45%, because that long-term money is accounting for a larger portion of the daily volume. When you don't have any long-term money coming to market, that program trading is probably 75% of the daily transactions. Now that introduces all sorts of chop, because what these programs do is they're searching for bids, they're searching for size, they're searching for asks. Once the momentum starts to wane, the market reverses the other way. And it's very difficult for day traders who look at a setup, they look at a breakout, they want to buy that breakout, and as soon as this trade starts to gain some traction, the rug gets pulled out from under you, and you start thinking, what the heck? Where did that come from? How am I supposed to even make money in this environment? So it's very important for you to understand where your opportunities are, and the way that we can gain that appreciation is to zoom out, take a longer term perspective. And sometimes the answer is fairly simple. It's fairly obvious. But if you're looking at what's happening intraday without doing that, then it all seems very, very random. So on a 30-minute chart right here, we can see that, okay, now we need to be a little bit more cautious. Now we get our market pullback, we get support. Can we get aggressive in here? Probably not. This is a substantial new low that took out many days of positive price action. This, I believe, was the jobs report from last month. So now the market gradually starts to find its sea legs again, and it starts to work its way higher. So these are areas where you can be a little bit more aggressive, because you know that the market is trending higher, and you have that dip, you have that pullback where you can start taking positions. These will be your strongest stocks. Maybe you day trade them. Maybe you even take a few overnight swing positions, because you don't have to worry that the market all of a sudden is going to tank, that there's going to be some disastrous news somewhere that's going to roil this rally. We've already seen all the tariff news, the trade deal news. The market's always climbing a wall of worry, but we haven't seen those really bad economic numbers. So we're going to continue to float higher, and I think the market heading into the Fed is going to continue to lean into that interest rate cut. So now we start to finally form some support. The market gaps up. It holds all of the gains from that gap up, and it tests the low from the previous day. Okay, this is where we can feel fairly confident that the market is going to start moving higher, and we can be more aggressive with our trades. So now we start getting into this relative high right in here, and we're going to start seeing some resistance as we bump up to it. So now we want to take some profits from these trades that we've been in. And lo and behold, it tries to get through that resistance and can't. Now we break out through that high the next day, and yes, things start looking pretty good. And now we've got another move higher that we can take advantage of, and now the market stalls out. We've got a double top. All right, now you have to be passive again. You can't come in on these trading days and expect a go-go market rally. It's just not there. The volume doesn't support it either. So we have to be very cautious. We have to sit back and wait for the next dip. And lo and behold, we get the next dip. So is this where I aggressively start buying? You can get a little bit more aggressive in here because you're starting to see some positive price action, but you're out and not holding a lot of overnights. The next day, you get a test with a higher low. All right, now we can feel pretty confident that support is forming. Do we take overnight longs here? Maybe not. Let's see what happens. Now we get this gap higher, and that confirms that that support is there, and the market starts to rally. This is where we can start to get a little bit more aggressive. There's an indicator that you can use to do this, and it's called LRSI. It's the Laguerre RSI, and I'm going to put it up, and I'll show you how that fits into your trading game plan. There are other indicators. This is really nice because it gives nice, clean, crisp signals. So you get a market rally to a resistance level. So no, you're not interested. When it rises above 20, this is where you would be a buyer. So you're not that interested here. You're not that interested here. You're waiting for that dip. You get the dip. Now in here, you can start to be a little bit more aggressive. Get another dip below 20 and a rally above 20. These are your entry points right in here. You get another one right in here. These are telling you that yes, this is where you can start to get a little bit more aggressive. And to be quite frank, this cross here above 20 didn't happen until this next morning. It didn't happen right here. So you're not getting in and going, oh, yay, it told me to get long. And look, I had this big market gap up. No, it crossed when you had that big gap up, but it tells you you can be a little bit more aggressive in here. Now you get another dip down in here. You get your LRSI cross here. We're still kind of waiting. Now we get another one here. Again, this is on a 30-minute chart. So now we can feel pretty comfortable here that we've got a double bottom higher low, and this is where our opportunities will start setting up in here. The other thing that you can notice from the chart is that when the market does gap up, this is where you're going to see your profit taking, because the market is not in go, gangbuster, gotta have it mode. These gaps up to a new relative high are often faded. And so by zooming out to a 30-minute chart, we can see that. We can start to get our bearings and go, this looks like a really nice market gap up, but I'm not going to rush in. I'm not going to FOMO into longs. I'm going to patiently wait to see if we get any little dip, any kind of retracement. And so as we look at some of these gaps higher, there's a gap up to a new all-time high. Smacked it right down. Hey, there's another gap up to a new all-time high. Smack the market right down. This is what we can expect off of those relative new highs. Do not chase them. Could there be some day trading short opportunities? Yes. If you're a seasoned trader and you're able to trade both sides of the market, yes, there are going to be some intraday shorting opportunities, but you don't want to hold those shorts overnight because the market is trending higher and you don't want to be holding a bunch of bags overnight, losing trades. So you have to be very careful to enter well, and you have to take your profits. You have to exit because you don't want to have a big market gap up the next day. And you need to be more inclined to do that off of these relative highs and not chasing big drops. So the mistake would be, hey, the market looks like it's finally rolling over. Look at that bearish day. I'm going to get super short in here. Oh, look, we've got follow through selling. I'm going to be short in here. And then you get these big moves higher that absolutely destroy shorts. So when it comes to shorting, you have to keep your time frame very, very short term. Enter well, focus on stocks with relative weakness. If you're a long-only trader, that's okay because you get these big gaps up. These are going to help you identify stocks with relative strength. Because when you get the gap up, let's say most stocks are going to be running higher. And that's the problem with gaps up also, is that all ships rise with the tide. So you don't know the fakes from the legitimate ones. And as soon as you get those market dips off of that gap up, this stock, and this stock, they look good early, but look at them all roll over and fail. But this one over here, during this market dip, it gapped up and it's holding all of its gains. So there are buyers there. That's relative strength. That's the towel that we lean on. So when you get these gaps up, again, you need to be very careful on the open. Do not chase. Wait for support. You don't have to short, but wait for support before you start buying. And so we get another gap up here and a big fade. Get another gap up here and a big fade. Another gap up here and a big fade. Hopefully you're starting to see the pattern. So this is what you need to do as a day trader, is to get that longer term context. Get it off of a D1 chart and then zoom out and go into a 30-minute chart and take a look at a longer time frame so that you can start to understand how you're going to approach the trading day. Here, you get a nice gap up on the open. You get a double top high. You have resistance right here. Okay, this is time to be careful. This is not when you want to be out there taking a bunch of longs, because they're going to reverse on you and you're going to be super frustrated. You're going to say, how the hell am I supposed to make money in this go nowhere market? Gap up, pull back. Okay, now that's where your opportunity could be. Once you start seeing that support is forming and it's around the prior day's VWAP, okay, we poke above it. I've got an opportunity in here. Now this was actually Thursday's price action. Everything looked pretty dang good. But here we go again. We're starting to make a new all-time high. Are we going to gap up the next day? Well, if we do, there's going to be a pullback, right? So we've already gone through that. So if you're going into Thursday thinking, yay, market's at a new all-time high, I need to be long overnight. Why do you need to be long overnight? If you did get a gap up, then you should take profits instantly on the open. Don't look that gift horse in the mouth. Take your profits, wait and see what happens, because you know most of those gaps up are faded. If you're wanting to be long and you get a gap up, you know you're always going to get a pullback. You'll have plenty of opportunities to get long, so you don't have to FOMO into trades. You also realize that, hey, this is August. These are the summer doldrums. There's no news to drive this market. I should not expect sustained rallies. The volume is really, really light. So when you start to put everything into perspective, you realize that there are going to be moments when you're a short-term trader where you can really strike hard, because you have those dips in this situation that you can really embrace. The market's going to find support. There's going to be some longer term money that comes in. It's not going to be as program driven. It's going to be some of that longer term money. These asset managers are not going to chase new highs. That's why you get these pullbacks on the gaps up. What they're going to do is they're going to patiently wait for dips and pullbacks. They're going to patiently wait for that support to be confirmed. And once they have that price action, then they're going to start allocating funds. Then you're going to get more consistent price action. Then you're going to get entries on your longs where you can actually sustain a move and ride them higher instead of constantly having to fight this herky-jerky type of price action. And when it comes to times of the year and price action and when do you make most of your money, I'll tell you that there are probably 4-5 weeks out of the year. If I took all of these mini windows of opportunity and combine them all together, let's say 5 weeks or so, that's when you can make half of your money in a given year, because everything lines up. You got the long term lining up with the short term for the market. You got the long term for the stock lining up with the short term for the stock. You have relative strength long term. You have relative strength short term. I mean, every checkbox is marked. And when you hit these windows, you just know it when you look at it. You're like, yeah, this is really good opportunity right now. That's when you can size up, and that's when you can strike. And that's not right now. When might I possibly see that type of setup coming? Well, I won't see it coming until I get a market pullback. But Pete, a market pullback might not happen. That's very true. We may not get that pullback. And if I look at when my best trading opportunities have come up, it's always been on an August and September and early October market pullback. And as the market pulls back, I've got shorting opportunities and I've got some momentum that I can take advantage of for a 2-month period of time or so. But I never take my eye off the ball. I understand that when the tide turns in October, year-end buyers are going to come in, and they are going to come in force. And that's when I'm going to make a lot of money, because I'm going to aggressively be trading that year-end rally. Asset managers want to mark portfolios up into year-end, and that bid is super strong, and I can count on it year after year after year. When I get a market pullback in August and September and early October. If I don't get that market pullback, then I'm always in hit and run mode. And then I can expect these little dips and an opportunity. Not a huge opportunity, not a fantastic opportunity, not an unbelievable opportunity, just day trading opportunities where I'm taking positions for maybe 2-3 days at most. And then you're out, you're taking gains, you're waiting for your next dip. And this type of price action could continue into year end. Lord, I hope this isn't what we see, because this is very tough for a short-term trader. So the best scenario for us, and we may not get it, is to see some type of market crackdown. Perhaps it's after the jobs report. Perhaps it's after the FOMC statement. If they don't cut interest rates, the market's not going to like that at all. But there's an 85% chance that they do cut rates. Powell has suggested as much, and that's what the Fed Fund futures are pricing in right now. But without that big market pullback, let's say, what is a big market pullback anyway? The 50-day moving average is not even a big market pullback, because it's pretty close right now. It's about 150 S&P points. Is that going to do it? Probably not. I'd like to get down to that 600 level. If I see a pullback down to the 100-day and 200-day moving average into mid-October, awesome. Now I've got huge upside potential into year end, and that is when I can get really aggressive. Back to the 50-day moving average. Yeah, it's going to be nice. That opportunity might last a week or two versus 2 months into year end. So hopefully this makes sense to you. And if we don't get that pullback, then we're going to continue to kind of chunk our way into year end. Yes, the market will drift higher into year end, but don't expect big gains. Expect maybe a 3 to 5% market gain with extremely hard fought gains as well. Very, very stubborn type of price action. Could the market lift off and we see some type of buying climax in here? Those are very difficult to predict. I'm not predicting anything like that. And you'll know it when you see it. And when you see that type of price action, there are usually hints of it earlier. And here you can see these tiny bodied candles. So I'm not expecting it, because what'll happen is you get stack green candle, stack green candle, stack green candle. And all of a sudden, asset managers who are under allocated, they start to panic. Uh-oh, I got this completely wrong, and now I need to allocate money because I'm missing this year-end move. Well, we haven't seen anything that suggests that. In fact, we've seen tiny bodied candles, which tells us that sellers are out there reducing risk and that there is a very stubborn move higher. Plus, I believe according to Bank of America, right now cash is at about 4.2%. As far as asset managers are concerned, which means that they've got most of their capital deployed. They're not missing this move. They've been fully allocated for quite a while right now. So if they weren't, that's when you could see this catch-up money come to market with these stacked long green candles and a blow-off type of rally. So I don't see that coming. I don't see the type of news that is going to spark that type of excitement. We still have the tariffs that are being imposed right now. There's a lot of uncertainty surrounding that. We've got some global uncertainty as far as economic activity and economic growth. So I don't see a lot of positives happening there into year end either. So there's no reason to believe that we're going to see a buying climax. And the kind of the scenarios that I've just gone through are to assess where my probabilities are. What are my most likely outcomes? Well, I've told you that a buying climax is not super likely, and that's because of the price action that we're already seeing right now. And I've told you that our best case scenario would be a nice big market drop. That is where we can start to get really excited. Plus, if we get that nice big market drop, we're going to see which stocks have actually held up really well. Those will be the ones that are going to lead the charge when the market finally does rebound. Those are the ones that we can take a little bit earlier positions on because we don't know exactly when that market low is going to be, where that market support's going to be. But we know if those stocks have been able to tread water and have great relative strength, that the downside is going to be fairly limited in them because those are the ones that asset managers are buying, and that's why we're seeing that relative strength. So we can cheat a little bit and get in a little bit earlier before the market actually puts in that ultimate low and be properly positioned for that year-end rally. But without that dip, we know that we're in this fairly low probability trading environment where we're just in hit and run mode and we're continuing to operate within those confines. So it means that you can't spread your wings, you can't get super aggressive with your trades. You simply have to wait for these dips, and these are going to be your buying opportunities. That's going to be your buying opportunity in here. That's going to be your buying opportunity right in there. And again, not seeing any substantial new highs, but seeing marginal new highs tells me that the selling pressure is building and there is resistance. So it's going to be very hard fought gains the rest of the year if we don't get that market drop. So zoom out, get the context, understand where your opportunities are, where you can size up a little bit, where you have to lay low. That's what traders do. And if you're able to do that and put those puzzle pieces together, everything's not going to seem as hard fought. It's not going to seem as random because you're going to know exactly where within that context the market currently is and how you need to approach the trading day. So let's take a look at my last pick was AEVA. And this is consistent with what I've just been mentioning to you. You've got this grind, float higher, not a lot going on. Well, if I'm going to take a bullish swing trade, then I want to sell premium, high premium, inflated premium, juicy premium so that I can distance myself from the action. I can lean on support levels and I can generate income while I'm waiting for conditions to improve. And so on AEVA, I like the fact that the stock had been really strong. It got overextended. It got overheated. And now you started to see some profit taking. The stock has formed a base. It's formed a base above the 200-day moving average. And now it's starting to move higher. We've got AVWAP-E right here at about $14 or so. And we sold the $15 puts for 95 cents. And this was in the Wednesday video. But Pete, the stock pulled back on Friday. Yeah, so did everything else. I mean, Friday was a pretty weak market day. Let's take a quick look at that. And this is going to illustrate exactly what I've been talking about. Very difficult market to trade when you get a move that lasts 30 minutes. The bottom falls out. We take out the prior day's low with ease. And then what? And then we sit and spin for the next 6 hours. Well, that's pre-holiday trading. Traders have left for vacation. The trade desks are empty. People are getting an early start to the 3-day weekend. When you come into the trading session, you understand that this is going to be a dull session. So the move takes place early, and then we just do nothing the rest of the day. Should I read a lot into this drop on Friday? No. We've seen plenty of these. I've just shown them to you. These pullbacks are opportunities. There wasn't any news to justify this huge drop, apart from profit taking after a big move higher. And if we go back, we can see that there are other days. One that comes to mind is this sell-off that we saw back in August 20th. Look at that. That looked pretty dang daunting. Let's get that LRSI off of there, and we'll be able to see it better. That looked really severe, and there was some volume behind it. And so the market finds support, and it tests that support. Now we've got our opportunity to start thinking about getting fairly aggressive with long positions, and we get this nice little pop up. And this is actually the Powell speech in Jackson Hole, and whoosh, the market shot higher the rest of the day. So I wouldn't read too much into the decline on Friday. I would look at it from a long standpoint as, hey, this is probably going to set up a decent buying opportunity. When we come in Tuesday morning, we've got news next week, so let's see how the market reacts. Let's see what the price action is going into the jobs report on Friday. But yeah, we've got a pretty good opportunity in here to look at stocks that have been strong recently and that pulled back on Friday and that could regain that upward momentum. So AEVA, I like it. We sold some premium. My thought on that is that I would like to buy it here at AVWAP-E, which this is where earnings came out. This is the average price since the earnings announcement. So you have VWAP on a daily basis. Well, this is VWAP calculated from right here after that earnings announcement. And this is where anybody that's been buying this stock is long, and that's why it represents a support level. So I would also like to be able to buy it at that level. If I'm not able to, I'm going to generate a really nice return. I'm going to make 95 cents, and I'm going to keep $7.50 in reserve. That's probably a 13% return in a couple of weeks. And I'll either make that based on time premium decay, and the stock will continue to move higher and it'll close above $15, or I'm going to take assignment and I'm going to own the stock at what I believe is a really decent price, and then I'm going to take advantage of upward price movement. SOUN. This is a pick that I showed you when the stock had broken out up here. Okay, and I'd said, I like this breakout right here. I'm going to generate some income off of this, and I'm going to sell the $13 put for 30 cents. Would I be, when the stock is all the way up here, would I be a willing buyer of this stock at $12.70, where it broke out here and that initial reaction post earnings? If the answer is yes, then do the trade. I think it generated a 5% return or so in a few weeks. And in here, it's like, uh-oh, here we go. Looks like I'm going to be taking assignment. If I already have the mental attitude that I'm going to take assignment. I want to own this stock. Then it's not a problem. I'm not panicking, and I've got plenty of money held in reserve. And look what happened on Friday. I didn't get assigned on this stock. It closed above $13. Well, when it was testing the 50-day moving average, and it survived that test, and when it opened a little bit lower on Friday, guess what I did? I sold the $12 puts 2 weeks out for 63 cents. That's going to make me long the stock somewhere in the $11.40 range. $11.40. That is even below the 50-day moving average and the 200-day moving average. And I've got a stock that's shown me that it wants to move higher. It's a no-brainer type of trade. And that is not an exciting trade. It's just an income generator. There's nothing wrong with that, especially when the market is not giving us a whole heck of a lot to work with. So these are the types of trades that you should be looking for. I am going to leave you with a long. Again, the main theme today is to avoid mistakes. When you get into very light volume market drifts higher, especially when they have marginal new highs, that tells you that you have to tread cautiously. And these compressed tiny bodied candles and those marginal new highs tell us that a dip is coming. So if you're a long only trader, you got to wait for those dips, wait for the support, and then you know you got your opportunities. Other than that, you're just kind of biding your time, and you're in a do no harm mode. You don't want to lose money and piss money away when you don't have good trading conditions. So I'm still hopeful that we get that nice big market sell-off in September and October. I don't know why it would happen or where it might come from, only that I know it would set up a really good opportunity for us into year end. And until then, I'm going to operate under this mode because the market keeps doing what it has been doing. And so come Tuesday and Wednesday, I'm going to be looking for market support, knowing that the market sold off Friday, and I'm going to be watching for those signs because that's what asset managers are doing. They're waiting to see if the bid is still there, and if it is, then they're going to start buying. They're going to support the market, and it's going to get a nice little consistent move higher. Nothing any super exciting. And Google is a type of stock that I would want to be buying. You can see that we have a nice trend higher post earnings. You can see how the stock is still fairly close to the EMA 8, so we're not chasing too much. And if we go into the 5-minute chart from Friday, we can see that there was actually some excitement in Google, but it backed off pretty quickly. Again, not a lot of volume, not a lot of traders around on Friday, but yes, there was some excitement, and any kind of pullback in Google is going to be a good entry point for day trading. Could even set up for some overnight swing trades because we have that little market dip that we can lean into. So know where your odds are good, know where they're not good. Don't make the mistake of trading all markets the same. That is today's theme. I hope all of you enjoyed your Labor Day weekend. I am going to be trying to do more educational type of content. I'm going to be talking more about patterns and setups that you're going to be able to identify and take advantage of. So look for that in the future. I'm going to be leaning a little bit less on the picks per se and the process of finding trades and a little bit more on education. If you find my content to be of use, please give it a thumbs up. Please subscribe to my YouTube channel. I'm trying to reach as many traders as I possibly can. I want to teach them how to trade, and in doing so, you're going to help elevate my YouTube channel. Thanks so much. We will see you next week.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.